John's number one idea is Spider S&P Aerospace and Defense ETF, which is XAR. So, John, unfortunately, it looks as though we're going to be spending more on defense.
Well, as you know, I have a bit of a defense analysis background. And so I look at these issues very seriously because I have, for example, 2 newsletters that come in every day on defense-related issues, including the Institute for the Study of War. So I'm very much attuned to this sort of thing. XAR is not for people who are ESG zealots because the companies within it manufacture missiles and all of these stingers, et cetera, that are being used so effectively by the Ukrainians against the Russian armed forces. Clearly, the Ukraine needs a lot more of these things. Also, the U.S. Is going to have to not only replenish their supplies, but add to their supplies, depending upon what kind of nuclear saber rattling Putin does over the next few years. So this ETF has all the big ones, General Dynamics, Raytheon, et cetera, and they also have Boeing. Now, the interesting thing with Boeing, and of course Lockheed for missiles. Boeing has been beaten up, of course, because of airplane crashes, but and then all the flight suspensions. But going forward into the increased tourism trade with the end of the pandemic, it's a good play. A lot of companies and countries are going to be buying new planes, replacement planes. So I like the fact that Boeing is in there, and there's a couple of competitors, including ITA from BlackRock, which is interesting because Larry Fink is so determined in terms of ESG and net zero by 2050. But however, they have a defense ETF as well. It's just that my preference is for the Spider offering, XAR.
We're back to the covered call banks, the BMO covered call Canadian Banks ETF, ZWB.
Yeah, well, I've recommended this thing over the years, and one of the reasons is it's just a core holding. Okay, it is in one respect a surrogate for the rest of the Canadian market. Also, our banks are strong. We have the option premiums on them are good, and it's just if you're getting the dividend tax credit on the dividends plus capital gains on the option premiums, that 7% yield overall becomes very, very attractive. And I was certainly using them a lot when, the rate of return on bonds was practically nothing. Going to ZWB was a great alternative. So, but I still think it is because the Canadian banks are well managed.
Okay, and then your final idea here is, I think this is essentially a money market fund or very similar,
yes.
CI
Yes.
High Interest Savings ETF.
Yeah, and you're absolutely right, Andrew. It's very much like that. This is made up of HISA accounts, high interest savings accounts. And for example, this one has Bank of Montreal, Scotiabank, National Bank, and CIBC, their HISA accounts within the ETF. Now, you don't get the insurance that you do on a HISA, okay? But these things are yielding about 4.7. So they're very attractive now. So I have moved out of my cash positions in bonds, and I've gone into about 1/3 Government of Canada bonds, 1/3 corporate bonds, and probably 40% actually, or more of these HISA ETFs. I just find them very attractive, and I'm not because I don't like GICs. I know clients have come to me saying, XYZ credit company is offering a very high rate on GICs, but if you're getting a high rate on a GIC, it's because you're getting subprime borrowers. Okay, and that's a higher risk, even though they're insured and all that. I don't like subprime lenders or borrowers, so I'm much happier with the high interest savings accounts from Canadian banks than I am with any GIC.